Okay, Mokama Sunday service. Today we are going to be talking about why the market tanked last week. Because this is primarily about market education rather than like strategy. So, for all the people out there on YouTube, this is for informational purposes only. Trading, investing is risky. I'm not a financial professional. You should refer all of your decisions and investments to your financial professionals and advisors, and or do independent research. So with that said, let me share my screen. Bam. Just go straight to the economic calendar. For me, I'm always looking, especially I'm trading, which was crazy just in terms of like this last week. And my trading went really well, but my long term did terribly because of the market drop, right? So, and it's crazy. And what I was trading was the safety names. I was trading XLU, the utilities. I was trading Coca-Cola. I was trading. I think I got a little bit on KRE, the regional banks, before they went down. So I wasn't trading the parts of the market like tech right now that's been falling. I've been trading like the consumer staples. What else? I know I had another decent trade last week on a relatively boring name, the ones that people put money in when things are going bad. They were trending and pulled back, so I hopped in those, and those kept going up while tech pretty much pulled back, right? So for me too, like me trading now is a way to kind of hedge my long term. I don't feel so bad about losing some of the unrealized gains that I had in my long term when my trading account is up a little bit more. So that's what happened last week, and this is why. Wednesday last week, well, actually let me pull up one. Damn dog. Let me pull up one more thing from last week um, that I think was a catalyst. So, Fed Chair Powell and the interest rate decision, the employment data that came out Friday, and Intel earnings, specifically as it relates to the semiconductor sector. So, let's start with Intel. When were their earnings? Look at that miss. That Can you see my screen? And
Yep.
look at that
Yep.
huge miss on earnings per share. And then they announced that they were laying off what 15,000 people. Um, Earnings terrible. Net income, their profit, they're losing 1.61 billion dollars. Profit margin terrible. I don't understand why the entire market came down on Intel earnings when AMD earnings were really good. I just think Intel is a terrible company. If you ask me, I've been saying this for months. Like they're the weakest in the semi sector because Intel manufactures its own chips and designs its own chips. But what they're going against is are companies like TSM that only manufacture chips. So they're going to be really good at manufacturing chips. And Nvidia only designs chips. So they're going to be really good at designing chips. And then they partner with each other. So it's easier for them to be good at one thing versus Intel trying to be good at two things. And it just hasn't been working, even though they got that money from the government in the CHIPS Act. So Intel tanked, which then tanked the semiconductor and the tech market. Nvidia, even AMD dropped. Like all of these other tech sector companies started dropping when Intel, right? So that was hammer number one was Intel earnings. I'm trying to figure out when was the actual earnings date. Intel earnings date. I could just go look at the chart. I'm sure. What was this? Was this August or July? Let's say Q2. It was August 1st. So what date was that? Oh, you know what? Let me go to my earnings this week. Go backward. Intel earnings were on Thursday. So I'm not sure if they were before or after, but this tanked. I feel like it was early morning. Um, it could have been after hours. It could have been after hours on Thursday. And when they reported terrible earnings, the entire semiconductor market pretty much tanked at the same time. So that was number one. Then number two, Fed Chair Powell, the interest rate decision was essentially to stay where we currently are. We're not hiking, we're not lowering rates, at least as it relates to the July decision. And I was cool for Wednesday. But then what happened on Friday was that we got some bad news with the U.S. unemployment or with the U.S. employment report. They were expecting a gain of 185,000 jobs. Now, a miss on this would have been like 160, right? Like 165. Then maybe that's, bad news is good news, but it missed like crazy. And they only reported 114,000 jobs, and they revised down some prior data, some prior employment data. So the jobs number looks even worse than that, right? And the unemployment rate ticked up to 4.3%. That's not a good thing. Where people are thinking maybe there's a recession around the corner, and people think that had the FOMC known that this data was coming out, they should have lowered rates this July rather than waiting for September. And so bad data or bad news is actually bad news, which is crazy because over the last few months, bad news has been good news. So, given that bad news is actually bad news, on Friday when this data came out, when did it come out? At 5:30 in the morning. Let me look at. Hold on. Let me pull up Thinkorswim. I want to show you the actual charts. Forgot to pull up my account. All right, let me stop sharing this. Let me share. You see Thinkorswim?
Yep.
All right, so let's look at Intel first. So look at that huge gap down on Friday, right after earnings. Like Intel was already beat up. That's what's crazy about it. Intel was already one of the worst performing stocks, if you ask me, over the last like 5 years. It's been one of the worst performing stocks, and then it gapped down even further. Like went from like $30 down to like $20. Right. So, and then if you look at the whole sector of SMH, because of that, it gapped down too, right? Because Intel, while it's not a huge portion of SMH, it reporting earnings that terrible weren't good for the rest of the chip sector. So a lot of the other chips traded down in sympathy with Intel being, in such terrible condition, and then announcing that they're laying off 15,000 people. So that's that. When was I? Talking about, let's look at Nvidia too. Right. So Nvidia held up a little bit better, and I know we're in this particular position right now, but because it's stronger, people actually believe in the stock. Its earnings have been great. Nvidia has performed a lot better and held up, at least from Friday. Like it came down and then it kind of came back up. But I wanted to show you, what was it, the overall market and how it reacted to, let's go to YM. This is the Dow. No, let's go to the NASDAQ. To the employment numbers. The employment numbers came out at 5:30 on Friday. This is the Friday candle. I like to go to the 5-minute chart, right, to see like when it happened. Oh, my screen. Let's see. What's that? It's right here. Right. So to kind of go and see like how data releases are affecting a stock, like you don't have to interpret it yourself, right? If the jobs number comes out, they were expecting 185,000 jobs and 115,000 were reported, and you're like, wait, is that going to be good for stocks or bad for stocks? All you got to go do is look at the 5:30 candle, which is when the data release happened. As soon as the data release happened, what happened? It tanked. It kind of got back up, but then it kind of tanked again, right? Just looking at the Dow. Let's look at YM too, which is, well, that was the Nasdaq. I'm sorry. Now looking at YM, which is the Dow, same thing. Look at that 5:30 candle. Soon as the data release happened, soon as we got the jobs data, it tanked, came back up, and then tanked for the rest of the day, right? So, and the reason why, so the first thing I showed you was the Nasdaq. That's mostly the tech. YM, the Dow, is more broad, right? It's filled with a lot of financials, energy stocks, industrials, not a bunch of tech, right? So that's that part of the market. Look at another cylinder would be the ES, which is a mixture of like the Dow and the Nasdaq. And if we go look at that 5:30 candle from the jobs data release, look at that, tanked, right? So I don't have to know whether or not like them releasing that jobs data, like is 150,000 or 115,000 a good number. Just go watch the market reaction. The market didn't like it, right? Literally upon the release, and you're looking at 5-minute candles, it started tanking, you know? You see that right there? And
Yep.
Mom.
Yep.
And then the fourth major cylinder is the Russell. These are the small caps. Look at that 5:30 candle. Terrible.
Even bigger.
Yep. So that the market didn't like the jobs data. Like that's the only thing I can conclude from that. Is like, okay, so now people are thinking the Fed took too long to lower interest rates where it might break the economy. They should, and so now that we are where we are and we have terrible jobs data, there's something called the CME Fed Watch tool, and it's like a predictor of when the Fed's going to cut interest rates. Their next decision is going to be September 18th, and pretty much everyone, there's a 100% chance that they're going to cut rates in September, right? The current rate is 5.25 by 550, and in terms of like the probability for the September meeting, like 78% people think that they're going to do a 25 point cut, and 22% people think they're going to do a 50-point cut. So that's a 100% probability that they're going to cut rates at least by that 0.25 that 0.25%. And then if you go out to November 7th, right, only 3.7% think that they're not going to cut again in November. And I know you invest in the housing market and whatnot, and houses and stuff too. So I understand from like a lending standpoint, like it looks like by November, rates should come down, mortgage rates and things should come down a little bit as well, right? So, but if you're looking at November, there's a 75% and 21% chance that it's going to come down even further. So right now, the market's going to try and price in 2 interest rate cuts before the end of the year, right? And if things get bad, then the Fed is going to cut even more, right? To try and stimulate the economy. But I think Friday was a reaction to the FOMC where investors were like, the Fed is cutting rates too late. They should have cut rates in July, you know. And I assume the Fed had access to all of this jobs data before we do, you know. So seeing how bad the jobs data was, I feel like they should have cut, you know. That's just my personal opinion. Let's see, what else? So those were the 3 main reasons why the market has tanked. Intel reported terrible earnings. The FOMC kept interest rates high and steady. And we got like ridiculously bad jobs data on Friday, which has got people scared that we might actually be heading into a recession. And then from a seasonality standpoint, typically August isn't a great month, but September is usually the worst month of the year. So we're also heading into a season where stocks don't perform as well as they do, like in the later parts of the year. So that's
So would you recommend a buy during September?
for
Like if
me.
you have them.
For me, it just depends on levels. Uh, Whatever
Mm,
levels that I'm looking at, that's the main thing that I want. And at the moment, like I've told you guys, my IRA is pretty much maxed out. Like in terms of what I'm able to put in it for the year, it's fully invested at this moment. So I don't. Most of my things are long term holds unless something tanks tremendously where I don't want to keep it anymore. So like I got a couple of leaps. I got that Google leap. The Shopify leap came down because of the market tanking where I might cut that. That'll give me some
mm,
extra capital. But I'm still looking at things that are at really low levels or are severely discounted because in my long term account, I want to hold things for like 5 to 10 years, ideally. So
yeah.
I've been waiting for Nvidia to get to a level that I could stomach to actually buy it. It finally hit that level, so I'm probably gonna hold Nvidia. I believe in the company long term. Google, that leap, I'm up so much. Like my unrealized gain got cut a little bit, but I still like it if it's above 160. If it gets below 160, I might cut that to get some extra cash. But let's just let's zoom out, right? Can you see my screen, my Thinkorswim screen?
Hmm.
Let's zoom out. So let's look at the Dow, right? Big component,
I'm
right?
sorry, can I ask
One,
you one more question?
yeah, go ahead.
Why when you look at the Dow, the Russell, and the Nasdaq, is the dash and the ticker symbol?
No, well, see, these are the futures. So the futures are open
Mm-hmm.
damn near 24 hours, like 23 hours a day. So if I want to look at what the market actually looks like right now while the market is closed, I'm going to use the futures instead of like the SPX or whatever, right? So the YM is the Dow futures, right? And all
Mm-hmm.
of these ETFs pretty much follow the futures. Like so these are the main like cylinders of the stock market would be the Dow, the ES, the NASDAQ, and the Russell. Those are the main four cylinders that make up the stock market. So if I'm looking broadly at the market and I want to see what the entire market is doing, I'm going to look at those four things first and then start digging inside of them, right? Um, does that make sense? So like if I wake up, if you look at my watch list and the Dow is down, the ES is down, the NASDAQ is down, and the Russell is down, that tells me we're probably gonna be down for the day, right? The whole market is down. If
Yeah.
the YM and the ES are up and the NASDAQ and the Russell are down, that means we have a mixed market today, which could lead to some chop. If all of these things are up, that means we're gonna be up for the day, right? And I've started trading things based on the futures, like so while all of these main cylinders in the market did bad on Friday, gold was doing pretty well and bonds were killing on Friday. So I
Hmm.
know specifically with gold, GLD, this ETF is going to track the futures. It's going to look similar. For bonds, ZB, right? I don't trade futures, but I know TLT is going to track bonds. They're going to look similar. So if this is what I'm talking, I'm getting into some of my day trading. Like if I see the market is down, there will be pockets of strength. So if I see these are open, I'm going to be waiting for an intraday pullback on like bonds. Because look, bonds killed on Friday
Hmm.
while the market was tanking. If you were hiding out in bonds, like you were happy, you know, because and same thing with utilities and staples, right? And that's why I said XLP. I have a Coca-Cola trade on, so Coke. While everything else has been taken, Coke has been doing relatively well the last couple of days. So I've made like what 15. I'm up like $1,500 on this trade right now. So
Nice.
but just hiding out in staples. Those are the only two things that perform well were like staples and utilities, the safety stuff and bonds. The safety stuff did well on Friday while tech was falling. So I've been while the market is falling, if I'm going upside anything, I'm going upside of the safety stuff, right? Waiting for a pullback on something like this, like you had a chance where it came down here, and
Hmm.
waiting for a pullback on something that's really safe because if people are afraid of tech, they're gonna put their money into safety. Because if you look at like most of these, let's say big hedge funds, um, or these massive institutional investors. Like when you have a 401k plan for your job, they can't just go to cash like we can as retail investors. They have to invest in something, right? So if they're selling tech, they're going to be buying something else. This isn't the 1930s where everyone's going to cash, right? This is, hey, we have this massive hospital, this massive university, this massive school, and we're investing all the employee funds. Um, if we're going to sell tech, we have to buy something else,
Hmm.
right? If you're
Yeah.
just thinking about how the market works, where all the big institutional funds are, like they can't just go to cash. They have to buy something else. So what they bought was bonds and staples on Friday while they were selling tech. Sector rotation, essentially. And so when I'm looking at the general market right now, we are still in a bull market if you zoom out. Now, if we get below this 1800 level in the NAS, I might change my opinion. But we don't see a lot of these. This 50 is nowhere near this 200 right now crossing, which is somewhat of a lagging indicator that we're heading into a bear market. But we are still what appears to be correction territory rather than being in a going into a bear market if you just zoom out. So this is the Nasdaq, and the Nasdaq has been hit the most, right? But if you zoom out, the Nasdaq's trajectory is still up. So until we kind of hit those levels below 1800, I'm still going to be relatively bullish in my trading. That's the Nasdaq. Let's look at the ES, which is pretty much a mixture of the Dow and tech. ES looks still pretty strong if you zoom out, right? We're having a correction, but this is still above this 200, well above the 200, and I don't see this 50 kind of crossing down. Tech got hit more than the general market. The ES, the S&P 500, this is the S&P 500 futures, right? The ES is going to be a little bit more resilient and because it has more than just tech in it, right? It's going to have some financials in it, uh, some energy, as well as a lot of tech. So this is more of a balanced ETF or an index. So it's probably not going to be as volatile as like the Nasdaq or the NQ. We look at the YM, same thing. Do we look like we're in a bear market, or if you zoom out, does it look like we just had a correction, right? We've had similarly bad days over the last like year, and what has it done? The market's still pushed up. So until we get further down here to like that 38 500 to 38 200 level on the Dow, I'm still going to be more bullish than not because it still looks like we're in a bull market, right? And if you look at the Russell, even the Russell, which has struggled the most, still above that 200-day moving average. You got the longer moving averages below the shorter moving averages, which is still more bullish structure. So until that changes, I'm still going to be more bullish. Or at least say we're in a bull market. Now, I might be more conservative in my trading and take smaller size, take shorter targets, but the market is still telling me from a structure standpoint that we are still in a bull market. That could change if we keep getting candles like this over the next 2 or 3 days versus a rebound. But the four major pillars of the stock market are telling me we're still in a bull market, right? If you zoom out, right? You just get out of the trees for a second. So that's why
Yeah.
I'm holding my long term. Well, my long term positions are long term anyway. If you look at a 5 year chart, let's look at like the Nasdaq. I got a lot of Nasdaq stocks. Even if I suffer some of these pullbacks, from long term, it looks like it should be good, right? If you
Yeah.
so, I just don't want to be buying here. I don't. From an Nvidia, the people that bought here, I don't. I feel bad for them. They bought there while we bought around here. So I feel a little bit more comfortable being in one of the better stocks, even if it dips a little bit from a long term standpoint. But if it keeps on this type of trajectory and we're just kind of in this area of this pullback, I still like it long term to hold on to it. I still think this is a stock of the future. Nvidia's margins are unbelievable. Its profits have been unbelievable. I think it's going to keep growing. It still doesn't have any competition in the AI chip space, with the exception of AMD, which still hasn't figured it out yet. So, yeah, I think where we purchased Nvidia is still a good place to take a bet on this stock while it's still above the 200, right? The 50's there. So, yes, it's kind of neutral now where it's leveled off, where it looks like it might start consolidating, and hopefully there are no more big drops. But um, buying it down here, and you said you got it at 103. So if you got this
Yeah,
at
I think so.
yeah, bro, you're fine right now. you're still
Yeah.
up. You're still up $4. My average down price was 106, like 50, right? I'm fine. I'm at break even, right? I'm not. I'm
Yeah.
nothing like the people who bought it right here at the absolute high, who have FOMO, thinking that it was going to go to 200. It's always going to pull back to one fib level, which is kind of where I wanted to catch it, where I caught it, a portion of it, and then I averaged down and bought some more down here at like 104 or something. But like, will it ever get down to this 200? It hasn't been there in so long. I don't know. But do I think Nvidia is ever going to get back up to 140? Absolutely. So I'm just going to hold. And
Yeah, I
my
might have to get in some more. Like I told you, I hadn't re-upped on the brokerage account, so I just throw what I had in there.
Yeah. And everything is discounted. So ASML, I might have taken it too early after the Intel report. It gapped down, right? Um, I, for one, think that Intel potentially going out of business is probably good for these companies because they're going to have less competition, and then Nvidia and TSM are essentially going to be king of the hill. But even this one, like, look, it pulled back down there to that 40%, being 40% off, and this is a really good stock too. HubSpot, like right now, there's some good deals on stocks. Like HubSpot finally hit my number at 450 and was there for a quick second. I should have bought it because that was my number, but like I said, my retirement account is kind of like fully invested now. Um, so I would have to trade. So really, what I'm looking for right now is trades. But I'm trading more in the stronger portions of the market, or I'm shorting the weakest portions of the market. Right. That's kind of what I'm looking at right now. But I'm still more likely to try and take something to the upside because, as I showed you, we are still kind of in bull market territory. I just want to find the strong stuff. So, like XLP. Like XLP has been strong. It's consumer staple stuff. Uh, let's look at what's inside XLP. Right. Procter and Gamble, boring stuff. Procter and Gamble, Costco, DeEntre stocks, Walmart, Coca-Cola, Pepsi, Colgate, Target, boring stuff. Um, that's what's doing well because, like, are you gonna still buy toothpaste in a recession? Yes. Are you still gonna Costco in a recession? Yes. Walmart? Yes. Is Coca-Cola? Are you still gonna buy Coca-Cola beverages and products? Yes. Pepsi? Yep. Um, I don't really trade Philip Morris like that. But the group that I'm in, they did do a trade on Colgate the other day, and I didn't take that trade, but I should have because staples have been doing really well lately. So let's go look at those stocks. So I know we kind of went over like the general market, but let's go look at like where the strength is. So some of those, so XLP has been doing pretty well. So let's PG, Procter and Gamble. Look at the days that the market has tanked. It tanked. Well, it looks like it got down here, but look, it had two really great days when the market was tanking, right? Costco.
Mm-hmm.
I invested in Costco in my long term. Costco hasn't been trending with the staples, but I'm thinking it's a laggard. This is why I bought Costco. I put this in my long term IRA too. I just like it from a strength standpoint, and it's boring. So, like, this is the type of thing, it's a safety stock. When do you think that Costco is going to suffer much in a recession? No, people are going to buy more things because it's cheaper, right? To shop at Costco versus other places. So this is like, hey, if the market's tanking, like Costco, I don't think is gonna fall like a tech name, right? Because this is not a tech stock. So I put some of this in my long term. Walmart, boring too, right? But look at this. While the market was tanking, Walmart held steady, right? It didn't shoot up like Procter and Gamble, but it definitely held steady. What else would we look at? Coca-Cola. I already showed you this one. This one I'm in a trade in right now. Coca-Cola safety has been really steady. What else is on that list? Target. Was Target on that list? Yeah, I think Target was. I don't like Target. Target has been heading down with this has been the exception. But I think it's like the weakest of the consumer stocks. Like why when we went over the 20 top stocks, Target didn't make the list, but Costco and Walmart did. I just don't think the company is ran as well as Costco and Walmart are ran. What else was there? Colgate. Look at Colgate. So while everyone is screaming that the market is tanking, look where the strength is, right? There's always strength somewhere. So it looks like all the institutional investors are hiding out in the consumer staples. That's number one. Same thing, XLU, the utilities, boring stuff, utility stocks. It came down on Friday, but look at the trend over the last 5 days while the market's not been doing so well. Utilities have, in fact, been strong, right? Crude, actually don't like crude. No, I have crude has been sideways. Gold has been killing. I've had a couple of gold trades, but this is another place that the market has been going, right? Safety. When the market's down, people invest in gold, right? It's a store of value. I don't trade the futures though. I'll trade GC. And this is what I also want to show you guys. These futures track indexes. So like the futures are going to drive the index and the ETF. So if I wanted to trade gold futures, I would use GLD, the ETF, to trade it, and you'll see it looks almost exactly like the futures contract if you look at the candles. Right? You see that? I'll go back to GC. Look at the candles. They look almost identical. So that ETF, GLD, is going to track GC. If you're looking for, I don't trade natural gas that much. I don't trade copper that much. I trade it through Freeport. But if you look at the bonds, ZB, and we look at, so we have 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7 green candles. TLT tracks this. It's an ETF of the bonds. You're going to see the same thing, pretty much, except for this candle. 1, 2, 3, 4, 5, 6, 7 up candles. It's going to look almost exactly like that. So if I'm trying to trade the bond futures, I'm going to go look for something in TLT. I'm going to go look for a spread in TLT or a call option, right? So, and really all I'm doing is just looking for what is strong. So we're still in a bull market. Things are still going up. What is still strong? And just looking at my Koifin app, over the last month. Let me refresh this because I don't know if this is what was up from the other day. Look at chips. Over the last month, chips have been the weakest. Tech and chips have been the weakest. So, not thinking about your long-term portfolio. The reason why I put a lot of chips and tech in my long-term right now is because I wanted it on a pullback, right? I didn't want it at an all-time high for a long-term. But from a trading standpoint, I'm not going to trade chips or tech to the upside right now. I'd be more likely to short these two things right now. What I do, though, I want to find the strength. What has been the strongest over the last month? Regional banks, real estate, utilities, which is what I've been trading. Gold, GDX is a gold ETF. Consumer staples, which is what we just looked at. Healthcare, another safety sector, right? So if I'm going to be trading right now or doing swing trades, day trading is like I'm in and out that day. Swing trading, meaning I'm probably not going to be holding it or the option is going to expire within a couple of weeks or so. I'm going to be looking for things in healthcare, consumer staples, gold, utilities. I don't really trade real estate names. And KRE, I'm going to be looking for pullbacks in those sectors to take long because those are the trending sectors right now. And if I'm going to be shorting anything, I'm going to be shorting energy, XLY, which is Amazon and Tesla. Let me go show you. Amazon looks terrible after its earnings, right? And because of the job data, like they're assuming, that's why I think Target looked like this too. They're going to be hurt the most if we go into recession. People are going to be ordering less Amazon products, less Target products. I feel like Walmart and Costco are more insulated to that because they're more bargain retail than Target and Amazon are. Amazon is bargain too, but it's just so big that I feel like people are going to be spending less, that it's more of a bellwether for the economy than like a Costco and a Walmart, right? But look at Amazon, look terrible, right? After Friday's jobs data and its earnings release. And then Tesla had a high and then it's coming all the way back down to its 200 moving day average, right? So that's why XLY looks like it does, right? And just to show you how they're linked, I always try to do this every single time. Just go look inside the ETF because the ETF is potentially going to move some of these stocks, right? What did I say? XLY, not XLP. XLY. What's inside XLY? Amazon, Tesla, Home Depot are the three main things there, right? Actually, I had a decent trade on Home Depot last week. Made a couple $100 on that too. But these are the three main components. So go look at Home Depot. Home Depot hasn't done that well either, right? But it doesn't look like Tesla and Amazon do. It's more of it's choppy right now. But just looking inside of the ETFs to figure out like where the strength is, where's the weakness. That Koifin tool that I'm showing you is free to sign up for. So if you're trading and you want to find like, don't trade SMH like to the upside right now, like on like these swing trades, because look how low it is. Yeah, pick it up in your long term if you want to hold it for 5 or 10 years. Pick up SMH or semis. Pick up tech. Pick up the Microsofts where they're discounted right now on your long term, but to be expecting it to shoot up to the upside when the trend is downward right now, may not be a good idea. Get out of your comfort zone, trade some things that you wouldn't normally trade, but that are actually trending in the market. So right now, like I love staples right now. Like if the market keeps tanking from a trading standpoint, people are going to flock to the consumer staples of the world. So that's where I'm going to be hiding out, or where I'm going to be doing some swing trades over the next week or two if the market continue to show some weakness, right?
And what you mean by that is try and catch it on a pull down or a pullback and then sell it when it goes back up?
Yes, either the ETF or the names inside the ETF. So like we just broke down XLP, right? So I don't trade XLP itself a lot because the options usually aren't that liquid, right? Look at the open interest for Friday's expiration. They're not that liquid. So that's a no for me. I'm not gonna trade anything and I'm not gonna buy shares of XLP. That's not how I day trade. I use options. So for me that's a no. And then if you go out, maybe August 16th has some more open interest, so I might take this one, but then I don't like the spread. Look at that 40-cent spread. That's ridiculous. So this has more open interest, but the spread is 40 cents. Is too wide. So even though I like XLP, I'm not going to trade the shares because that's not how I trade to get alpha on a trade. And there's no liquidity. There's liquidity in the open interest, but the spread is too wide for me to trade it. So I'm going to go, okay, since I can't trade XLP itself, what's inside XLP? Well, I just showed you. Procter and Gamble. What's heavily weighted inside XLP? Procter and Gamble. So then let me go look at the options here. The open interest looks a little bit better. Let me look at August 16th. Yes, there's way more open interest, and the spread isn't nearly as wide as it relates to the entire price of the option, especially these right here. Actually, these are a little wide too. PG spreads are wide as well. So then I might move on to the next name if I don't like the way Procter and Gamble is setting up. But I actually do. I would probably be waiting for a pullback on Procter and Gamble, right? So if Procter and Gamble were to pull back on Monday, I'm trying to take this. It looks strong over the last few days for a swing. So if it does pull back, that's a name. If I can find some liquidity in an option, maybe I go a little further out from August 16th to the 23rd. 16th looks like it's more liquid. As this pulls back to 165, usually the spread won't be this wide, so I would probably try to take this option right here to the long side on a P&G pullback, maybe to like 165.50 or something like that, right? Just as an example. And if we keep moving on, Walmart was a big name inside. Um, I don't like Walmart because it doesn't look like XLP. I'm looking for things that are going to move with the sector that I'm tracking that's doing well. XLP looks more like PG than it looks like Walmart. So Walmart isn't tracking with the sector, so I might move on from that. Just showing you like how I might scan for things.
Yeah,
Costco
no, it's excellent.
not moving with the sector like that, so I probably wouldn't swing that. Coke or Coca-Cola does look like the sector. That's what I'd be waiting on a pullback on. But I'm actually already in this name, so if we look at, I'm in Coca-Cola right now. I'm up $1,000 on the trade. You know.
So what you're saying is you would let's for example, let's use this Coca-Cola stock right now. Let's say it pulled back to like 65. You would purchase an option to purchase it at like 66 and then and maybe have that expiration date be a week or two out, and then when it jumps back up you sell the option.
Yes.
Is that how you
So for me, like I have these ATRs on right now, the true range. So if I see, I don't know what the true range is going to be calculated for Monday. On Monday, it'll show
Yeah,
me
yeah,
the
yeah.
true
These are
range.
just yeah, I'm trying to figure
If
out the
if it gets relatively close to that, and then I also have another indicator that I purchased called the daily price movement range tool. So if it gets within the range of my daily price movement range tool and uh, gets close to this ATR or they're like in the same zone, then I would hop in right there, likely thinking that it's exhausted for that day and gonna pull back up, you know. So what I would do is figure out what level that is. So let's say so let's take Friday. Let's take Friday for instance. In fact, let me pull up my other tool. So Coca-Cola on Friday. It did actually get in that zone. So Coca-Cola on Friday. Here is my ATR right there. Is that dotted green line? Let's say if I wanted to take it at 68, right? That would have been my level approximately. I probably even would have took it at 68.50, but let's say I would have waited and got it at $68. What I would do is go look at the option around that level and see if there's any liquidity, right? Because I want something. I know when this drops to 68, this is the option that I'm gonna want to take, right? It's a 68 strike. That's gonna be right here where the 69 is if it drops to 68. You following me? This
Oh,
ladder, this
sorry,
la-
sorry, I was on mute.
this ladder moves. Do you feel me?
Yes.
All right. So right now we're at $69. Because we're at $69, the strike that's closest to being out of the money is 69. If we drop to 68, this 68 is going to drop to where 69 is right now in the options chain. Right? You follow me?
Yeah, and you're buying a call right now or a put.
Yes, if I'm betting on it to go back up,
Yeah,
I'm
you're
gonna
gonna buy the
go
call.
try to find something that's liquid. That's why I'm in Coca-Cola. In fact, look at the name that I'm in. Look at the liquidity there.
Yeah.
So like that's how we knew. Oh, everybody was hiding out there. So it was a sign that hey, maybe this is a good strike price to be at. So but 68 has some decent liquidity too. So if I wanted to catch this on Friday at 68, this is probably the strike that I would have taken. There's liquidity here. There's 1,500 open interest. The spread is only 13 cents apart, so it's not an extremely wide spread. That'll probably decrease in size as it gets further down to a $68 stock price. So that's the one that I would take. I would copy that. And then for me, I have a kind of a day trading setup that I like using. I'll copy the actual price of the option because the option itself, you can track the option price of the option by copying it, right? Just to show
Yeah.
you what I did, I went in here, I right clicked it, and I went copy the option. Then there's an actual chart for the option you could copy and paste into this screen, and it'll give you what it looks like, right? And so then I would just come in from a day trading standpoint or swing trading. I'm coming in and then I'm looking on a 5 minute chart to see it get close to 68 or $68.50, right? And then figuring out where that price is going to be at that point, and then I usually use Active Trader to get in. So depending on what your budget is, my budget typically for a swing trade is going to be $1,200 because of my account size. I don't want to risk a certain more than a certain amount of my account size on every trade. So my typical entry is going to be about $1,200 worth of options. So if the option price I anticipate is going to be at like $1.50, I'm going to go to my calculator here. I'm going to do 1,200 divided by $150, which is 8. So that's why it's defaulted to 8. I'm probably going to buy 8 of these options and then wait for it to sync to a price that I wanted. So if that price is 150, I think, hey, when it gets down to $68, the option price is going to be around 150, right? And then I'll put in an order right there on Active Trader. And then when you do that, just to show you, like you can kind of approximate. So if the option price right now is 185, right? So I'm looking for that option to get cheaper. If I put that down, it'll tell me approximately where that's going to be. So 150 might be too high because that's going to be at 68.73. And remember, I said I wanted this at $68. So in order to get down to $68, the option price might be close to like $1, right? Yep. Or my ATR right there. So let's say if I wanted to grab it at my ATR, and I said I really want it at like $68. That option is going to be around $1 when it gets to $68, right? You see how I did that? Then
No, but I'm gonna
I can
keep
al-
going. What I'll do is I'll look at it again
I can almost
when
approximate the cost of what this option is going to be when it hits $68 by putting in a trade well below the current price of the option. The current price of this
yeah.
auction is $1.85. And if I say I want this at $68, then I can kind of put in a trade and figure out approximately where the price is going to be if this gets down to $68. If this is going to move a little bit based upon volatility, how much time elapses, but like if in the next 5 minutes this were to fall to $68, the option price would be around $1. So this would fall 85 cents. So if I want to be even more conservative, I might put this order in at 95 cents because I just understand that option pricing is dynamic. So when an option falls in value, or when the stock price falls in value, the option price falls a little bit faster. So if it says a buck now, it might be like 5 cents a wiggle. And I said I know this from just trading options consistently. So I'm
Yeah.
gonna maybe put in the order a little bit further down and then maybe set an alert at like 68.10 to tell me to go look at this, to enter this trade. But that would be my pullback on Coke, right? Just go back to my normal view. Right. I'm just showing you like that's what I'm looking at from a trading standpoint. Where's the strength in the market? And I want to pull back on something that is strong because that's likely to keep going back up. Or I want to pull back to the upside on something that is extremely weak, like Intel. Like I can't wait to get a pop on Intel. If Intel comes back up to 30, I can't wait to short it. Right? So it's the same thing. That's what I'm waiting on a pullback, but it's a pullback to the upside. And then you're going to sell something that's weak when it looks like it's exhibiting a little bit of strength. Then I'm going to sell it and I'm going to short it. So it's still a pullback, but it's just a pullback to the upside rather than to the downside. So
Yeah.
that would essentially be my strategy for next week. Go and so SMH has been the weakest sector, which is with chips, and Intel has been the weakest stock in the weakest sector. So that's my target to short. The strongest stock in the strongest sector, which has been consumer staples, has been Coca-Cola and like Procter and Gamble. So if I'm looking to take something long, it's going to be Coca-Cola and Procter and Gamble. And in fact, I'm already in Coca-Cola and XLU, which has been strong recently. So I'm in a trade on XLU. And if you look at those trades, right, and I've even exited some of these. So the open percentage of Coca-Cola is 995 or $994, but I've already scaled out of this trade. If I have three left, I think I started with six. And then XLU, I have, what's my position? I have one left. I started with three. So I've already made money and scaled out of these trades. And I have these stops at break even. So I'm playing with house money on both of these trades. But they're not in sexy sectors, right? No one
Yeah.
wakes up thinking of trading Coca-Cola or utilities. But they've been a good hedge for the tech sector because people are fleeing to safety right now. So I am going long safety, even though I have a lot of tech in my long term. Feel me? Does that make sense though? Kind of like how I'm trading.
Yeah, it does. It does. I
Yeah,
do need to I'm gonna have to go back and watch the video to
yeah.
see the specifics, but
This is
the strategy makes sense.
this is what I missed was gold. This is the one sector I missed. I wish I would have stayed. I did make a little bit of money, I think, on one of these candles back here, but gold has been steadily trending up. And so I'm waiting on a pullback in gold too. So that's the other sector. But I usually trade that through the ETF, GLD. But that's been the other sector that's been strong. So I've been liking utilities, consumer staples, and gold. Those are the three things that I'm looking to trade pullbacks on next week. And then the next week it might change. If we see a surge in tech, then I'm gonna go back to Koifin, go figure out what's strong now, Because sometimes it changes on a week to week, month to month basis, and then do the same thing over and over again. When tech becomes strong, then I'll start trading pullbacks on tech again, right?
Yeah.
It just, I'm just looking for strength in the market, um, and what's trending, and then grabbing something that's trending on a pullback and take it to the upside, or what's trending downward, grab something on a pullback to the upside, and then short it to the other side. Short the weak and go long on the strong.
Sounds like a catchphrase to me.
Yep. All right, that's it for this weekend. This Sunday, Mokama Sunday service. Any other you want to look at anything? Any other questions, comments?
No, man, I'm just excited to go back and look at that example you showed. I want to really delve into that.
Yeah, but that's if you're trying to trade. Like long term investing, is like you're really looking for discounted stocks. If you hold something that you really believe in that has good earnings for 5 years, it should be higher in 5 or 10 years. Even just doing the ETF route, go take QQQ and SPY, or depending on your platform, VTI, VOO, and like a couple of blue chip stocks like a Microsoft and an Apple. Oh, that was the last thing. Did you hear the news on Apple?
No, what happened?
He dumped 55% of his stock in Apple. Warren Buffett.
Did he?
Yep. So be careful. So Warren is going. Yes. So remember that leap that I had? I made like 8 grand on that Apple leap. I'm kind of glad that I sold, because this is kind of telling that the biggest Apple investor is dumping his stock. He's dumping billions of dollars in Apple stock. So that's not
Mm.
good news. So this isn't good news for the tech sector, because Apple makes up such a huge part of the indexes of the NQ and the ES and the ETFs inside, especially the tech ETF. So this is something else that doesn't bode well, that Berkshire is trimming its stake in Apple by 50%. That's a ridiculous amount. So there's a lot of selling going off in the tech sector, specifically in Apple right now. So, and this is after Apple did, it reported decent earnings. But people are afraid that it doesn't have like a new product. But the
Yeah, it
earnings,
hasn't innovated anything in
yeah,
quite some time.
but its earnings were pretty good though. They're pretty decent. But people just think it's too high, and just the fact that Buffett trimmed his stake and cut it, that doesn't look good. That there's a massive seller in the market. So, yeah. So watch your head. But yeah, that was
Mm.
some more big news last week. So, just in terms of why I'm also not like on the tech sector in general, I'm not like extremely bullish short term, is because of things like this. I think it should pick up towards the end of the year. The long term positions should do pretty well, just going forward in the future, especially if you bought on this pullback, or even if it pulls back a little bit more. I do think tech is going to be fine in the future, but right now it looks like people are fleeing to staples and safety stocks. So that's what I would be trading over the next week or two, unless we see some massive comeback in tech over the next couple of weeks.
Mm.
Righteous?
That's not good. 50%, man.
Well,
That's not good at all.
I know it ain't.
That's
That's a lot, man.
It's
That's a
alarming.
lot.
Yeah.
we
it's
do not know. That's a lot.
it's alarming. And see, that's why, like, look, I like Nvidia, I like ASML, even though my ASML is down, but I just like that stock. I got it cheaper than what I got it for earlier. In fact, like, I think I had made like a couple of grand off that stock earlier part of the year. So I'm probably back down to break even. But it's the picks and shovels play. Like, all of these other companies have to figure out a way for AI to increase their earnings, right? They got to create a new product, something, right? Integrated. Nvidia does not. ASML does not. They make the chips. Like, they just make the components. So if AI grows, Nvidia and ASML will grow because they make the components for that sector growing. It doesn't matter who wins. It doesn't matter if Apple wins the AI race, Google wins the AI race, Microsoft wins the AI race, Amazon wins the AI race, CRM, whoever. It doesn't matter. If AI gets bigger, Nvidia and ASML get bigger. So I'm taking the picks and shovels. Like I've been in Google. I got Google when it was down at like $120. So I'm staying in that trade. But I'm just just talking my long term. I like Costco. I think Costco does well in a recession. I like Nvidia. I like ASML. And then what else do I own? What do I own? I have a bunch of ETFs in my long term. I have QQQ. I think I got some SPY. I got some XBI, which is biotech. I bought that super low way in the past, so that's up. But that's really what I'm looking at is semiconductors, but like the picks and shovels play of the semiconductor market, and yeah, like some like safer stuff. Like if I could get Walmart on a pullback, I'll F with Walmart too. Because what's going to do better in a recession than Walmart? Um, it's the cheapest stuff you can find, and they have groceries, and they're getting better with online sales. But yeah, but all of these other companies right now, if you're looking for things that are cheaper, if you were thinking about buying HubSpot 2 or 3 months ago, now it's 50% off. Like, what do you think? Why are you still thinking about it? Buy it, you know? And if you're trading it, set a stop. But if you're taking it long term, like if you think the company is going to be bigger in 5 to 10 years, this is the time to start grabbing up things while they're low, especially in the tech sector. So everyone was like, "Oh my God, tech is all time highs. Tech is all time highs." Like, "Oh my God, when are we going to get a chance?" Here's your chance. When everybody else is scared, this is your opportunity. Amazon dipped down there 10%. If you've been wanting to get into Amazon, here's your opportunity. Find a level that you think it's going to level out at. Maybe wait a couple of days to get a couple of candles of consolidation to think that, okay, maybe this is a stop where it turns around. But take a shot, especially in your long term. If you were willing to buy Nvidia when it was at $140, why aren't you willing to buy it when it's at 100? You know, so nothing's really fundamentally changed, and Nvidia's earnings are about a month out. And then also, just one other thing to be careful about is earnings. Go look at what's reporting earnings, what's coming up, and if you're trading, be careful trading on the day before and after earnings, even leading up to earnings, because you might have some more volatility. We got Amgen, Caterpillar, Uber, Airbnb coming up next week, Novo Nordisk, Disney, Eli Lilly in the healthcare space. So yeah, we got all of the biggest tech companies pretty much have reported, with the exception of like Nvidia, which typically reports late in the season. But everywhere else, yeah, we're kind of in the middle to end of earnings season right now. But yeah, that's it for today, gents. Till next weekend. If anybody wants to join the actual Zoom, leave a comment on one of my videos. Mo Kama, Sunday service, making it rain without the umbrellas.
This nigga gotta end with that.
Yeah.
You gotta end with tagline.
Yeah. All right. I'll see y'all next week, though.
All right, man. Appreciate it as always.
Yeah.